Hello, everyone, and welcome to the Coinbase Markets Podcast. I am Dave Duong, the Global Head of Investment Research here at Coinbase. I am joined, as always, by my colleague, Colin Basco, who works with me here in research. Colin, let's just jump right in because it has been a crazy time in markets, although I guess you can kind of pick apart any time in the last 3 months and say that same exact thing. But literally, we've been seeing the price whipsaw here. Like last week, we thought we could catch a break with Bitcoin. It was finally kind of catching up to that 95 level. And yes, we said that had to do with short covering. And so we weren't sure how durable that was. But we came all the way back to that, 87 level. Now we're kind of range bound here. There's been things going on in Davos, things going on with Japan. I mean, I don't even know. Where do you want to start?
Yeah, I feel like we missed an entire news cycle, to be honest, between the time of our last recording. And it's just, news cycles are moving so quickly now that price is just moving all over the place. We got precious metals rallying past all-time highs and Bitcoin not really following through. So I guess we'll start with Bitcoin. So just like a quick walkthrough in terms of what we're seeing in prices. Like last week, we saw long liquidation spiking at around the 87K region, which is pretty much in line with where we expected price to have to hold, just given the fact that the 87 to 90K band was where we saw a significant amount of Bitcoin being purchased from short-term holders. And the reason why we think that has to hold is because once that region fails, then you have a bunch of short-term holders, a large amount of supply would then be underwater. So then the probability of those short-term holders dumping their Bitcoin to get out near break even or just capitulating, I think the probability of that continues to increase the farther down we go and for the longer amount of time that we spend below that region. So right now we're kind of in pretty tentative territory, I'd say, just given the fact that Bitcoin is just kind of ranging there and we're not really seeing a strong persistent bid yet. We saw some digital asset treasuries buying last week, but even them, they're not able to stabilize the narrative right now. We're seeing MNAVs have not really improved. They're still sub 1. So it still does seem like the MSCI debacle really has some sort of persistent effect on the equity valuations of these companies. So I think overall the bid is not necessarily strong right now. I think 87K, we saw strong buying from the first initial test of that, but we're now again retesting it over the weekend. We got the tariff news again. So I think that may have catalyzed some of that drawdown. But from an options perspective, I actually reran the data today. And that data is pretty much a wash at this point in terms of positioning, because what we saw was originally we saw some relief in the bearish positioning after Davos and after the Truth Social Trump tweet, where there was the potential promise of a new deal and the removal of some tariffs. But once again, we're getting back in sort of to the tariff territory again this weekend and then today and yesterday. So I think we're not really seeing that significant change in that options positioning. We saw a surge in premiums from put selling, which is slightly bullish, but then we also saw an offsetting decrease in buy calls, which is not bullish. So overall, I'd say it's just relatively a wash on the positioning front. But David, I guess what is your perspective here?
Yeah, I agree with you. I mean, definitely the fact that so much of the accumulation was done around that 87 to 90,000 level. I mean, I think that this is a critical support band right now. So it's tough, but I hesitate to think that a lot of this is just driven by these kind of macro factors. I know that's what a lot of people are attributing to it. And certainly there's a lot of things going on. I'm not disputing that. Over the weekend, we had the Canada tariffs. Just yesterday, he talked about the South Korea tariffs. We've got the Fed meeting tomorrow. Obviously, I want to talk about precious metals too, because that was I think a crazy move in terms of what happened predominantly with silver. But, what we're seeing in Japan, it's probably more tangentially related to our space, to be honest, but still something I think really need to pay attention to, because this is a crazy kind of move inside the yen. I'm going to put a chart up in a second, but where I'm at, I do think that this is probably more technically driven than it is more narrative or macro driven, to be honest with you. And so I think a lot of people bring up this idea of gold's moving. When is Bitcoin going to catch up with it? And we've been hearing that for such a long time. We heard it when gold was at 4,000. Now it's at 5,000 and above. I'm always hesitant to say that actually, historically, I don't think we've actually ever seen that either. So which is why like capital rotation between Bitcoin and gold. And I'd love to see if I think you've done some work on this, Colin. So I want to get into that. But like the reality is, I think a lot of this can be kind of attributed to poor liquidity in the market. The fact is, like, if even on the option side of things, and I think this is worth kind of looking at because this is where a lot of the big price action has been. There's just so much short gamma built up around the 90,000 kind of levels and below that it's keeping us pinned below that 90,000. Now, the good thing is probably some of those positions could come off on January 30th. But even then, like we're kind of capped on the upside because you have so much long gamma waiting for you on the other side at the 100,000 level. So I think that these are the things that we really should be paying attention to, but it's so hard because the narrative is so busy right now. But what do you think about the Bitcoin gold? Am I off the mark here, or like is your study kind of show that my intuition is kind of right?
Yeah, I've heard a lot on Twitter, and I mean, you always see these stuff floating around Twitter. People are just posting absolute nonsense whenever they feel like it to get clicks. But I think the gold to Bitcoin rotation trade and that narrative is something that people resurface relatively frequently whenever they see gold prices rallying, because a lot of people are Bitcoin maxis and they want to see whether or not there's other flows that will flow into Bitcoin. And one of the popular ones is that when Bitcoin or when gold rallies, that eventually those flows will eventually translate into Bitcoin flows. Now, I don't think that's true. So I don't think that actually works in practical a use case. Like, I don't think you can tangibly trade that. I think it's something that people like to bring up a lot in the academic literature and try to analyze from that perspective because it sounds like a really nice narrative. But in reality, I don't think it works. So a couple of reasons for this. The first is, like, from a statistical perspective, if you were to analyze this, the lead lag relationship between Bitcoin and gold, it needs to be persistent if you want to be able to actually trade this in reality. There needs to be, like, the rotation logic for it to be tradable. What you'd expect both a stable sign, so either positive or negative, and a stable horizon, so an actual period of time which you could use as a lead lag reference to translate those flows from Bitcoin to gold or gold to Bitcoin. And the problem is that there's no real horizon or stable sign period of where there's any positive, like statistically meaningful positive or negative relationship between Bitcoin on any rolling correlation basis. So it actually it's the opposite. So in practice, what you'll see is that the rolling cross correlation between the returns for Bitcoin and gold, what'll happen is it'll actually flip sign across regimes. And so there's a bunch of different types of regimes. Like, you have your risk off versus liquidity regime, you have your inflation scare versus growth regime, et cetera. So there's a bunch of different macroeconomic regimes, right? But that itself, like the different regimes itself, those relationships will change based off of the type of regime. And that relationship is a problem because then it's no longer a robust relationship. You now have to condition the relationship based off of these other external macroeconomic variables. And that brings us to the second problem. So the second problem is that the common drivers for both of these assets, there's a lot of overlap between those. And that tends to confound the relationship. So, for example, you'll have things like real yields, dollar strength, and liquidity conditions tending to affect both Bitcoin and gold. But they'll affect Bitcoin and gold at different speeds, meaning the speed at which investors will react to those macroeconomic variables in terms of their tangible investments into these different assets will change both on a magnitude level as well as on a time level. So it'll take more time for them to allocate into either of those assets as a response to the same macroeconomic variables. And that creates this kind of fake illusion of some sort of lead lag relationship, but it won't hold in terms of like an actually statistically strong linkage unless you actually condition it on the tail end of those risks. So for example, like 2022 was a period where you had like 40-year inflation highs, right? So it's a very insane like tail end risk type of macroeconomic environment you won't see very frequently, which then becomes another problem, right? Because even if the relationship can be statistically significant during a crazy period like 2022, the problem then becomes you're not only looking at the tail risk events. So the tail risk events, there's just naturally just going to be a much smaller sample size of those events, right? So then you get into like a problem of sample size errors. So then now you're looking at a period of maybe 3 periods, I'd say, within the past around 10 years that Bitcoin has been alive. And that's also a problem because if you see a rotation only a few times, then you can't really rely on it as a repeatable edge, right? Because then the Taylor regime doesn't provide enough repeated observations for you to actually learn a stable mapping. So that also becomes a problem. So like the whole thing is a mess just from like a statistical perspective. And it also just doesn't make sense when you consider like the opportunity cost of other types of investing styles that you can generate like thousands of sample sizes. So like a lot of technical models will be able to generate like at least 100 different sample sizes of trades that was, fit whatever rubric they're following or whatever ML model they're following. And you'll actually have a real sample size, right, based off of that. So like it's just a mess in terms of like people using like very few sample sizes to justify a specific trade. And I see this all the time on X, which I don't know, it's kind of bugs me, but especially because I also live trade a lot of this stuff. So when I was researching to build my own quant models, like I read all of the academic literature, tried to replicate all of it. All of the academic stuff tends to be nonsense. And you'll see a lot of that being, pandered on X. And it's like, if it can't even pass like the most basic middle school statistics class in terms of a sufficient sample size, then it shouldn't be traded.
Yeah, I was at a conference in Miami just this weekend. It was a Real Vision conference, actually, for anyone who's familiar with it, the Crypto Gathering 2026. And I will say that this topic comes up, and I said the same thing. I was like, listen, from a statistical perspective, like just having 6 data points, if we, like there was this chart about, gold crossing a certain threshold at the same time, like stocks and Bitcoin. And like every time that happens, something happens. I'm like, every time it happens. So six times that's happened. Like it's like these things are so statistically insignificant that people bring them up all the time. And I'm with you. It irks me. But then again, I'm a stats nerd. So I guess it should kind of irk me. So, I mean, obviously, so much to chew on. And I mean, beyond just the idea of like capital rotation from gold into Bitcoin, I mean, I think everyone just wants to talk about this topic. And it's funny because I remember a few months ago, we wrote about like how, like, can we stop talking about gold? And obviously the answer was no at the time. It's even more so somehow today. But this was a great tweet. I'm going to share this right now. If you're watching on YouTube, you can probably catch it. But there was this tweet, and it's one of many, but like this is a Kobayashi letter where they wrote, gold and silver raised $1.7 trillion of market cap in 90 minutes in one of the large reversals in history. This happened just yesterday. Like, we got to talk about it. Like, what happened here? Obviously, like things are kind of coming back right now. And let me show you the chart of silver at the moment. Like, you can kind of see this is the movement that we're seeing in silver. Like, this was yesterday. This massive 15% down move. And then we've kind of come back. Although, we like cheating. We talked about this before the show, Colin, you and I. And like, we still, it's nowhere near where we even like started the month. We started the month, I think, on like, 70. So we're still like way, way, way above that. I mean, Colin, what do you think here?
Yeah. Can you zoom out on that chart to do like the daily chart? Because I think if you zoom out, you'll be able to see like whether or not the rejection was severe. So a lot of times you'll have like a blow off top when you have a parabolic run in any asset. And like the easiest way to just look at a meme coin in crypto, you'll see this all over the place where after like a huge parabolic rally, you'll see like a lot of people just taking profit after some huge sell off to try and just because they're afraid that their entire pump is going to get retraced. And I think you see this sort of psychology played out across all markets whenever you see valuations go to an extreme. And so here, even if you actually look, like when you zoom out on these charts, it actually doesn't look bad at all. So like, especially like on gold too, like it's like a momentary blip in terms of the actual pullback. So for me to actually become bearish on these types of assets, like you need to see a really significant correction or like an actual break of like a bullish trend line, which you're not seeing. And I don't think you probably won't see. I think the probability of gold or silver losing trend from now is very low probability because the pullback that would be required to break trend right now would be extremely severe because it's diverged from the trend line so significantly. So I think there's the probability of, this volatility at this extremely wide divergence from the trend line is very probable, but I think a lot of it's just going to be noise, to be honest. I don't think a lot of these moves are going to be really trustworthy until you start to see movement back towards the trend line, and then you'll be able to see the movement where like the buying and selling at a key like support level. That's I think where it becomes more important to see whether or not you should start layering out. But for now, no, I don't think
Yeah.
there's too much to read into it.
It's crazy when you step back and move away from that daily candle chart all the way. I'm showing a 5-year chart right now. And like we started 2025, like a whole year ago, back at like a market cap of $1.5 trillion ish. And now we're at like 6.5 trillion. And it's like, it's crazy, this move, expecting that was just going to continue up and to the right, or in this case, just like a rocket ship straight up forever, I think was kind of, I mean, somewhat misguided in my view. So I will admit to the fact that like I think trying to get in at these levels is pretty tough if you're looking at this chart, because it's like, man, like, yeah, like do I want to really get in at these levels? Like it's not quite attractive anymore. So I think that's kind of the tough part here now. But
I think it's
go ahead.
Yeah, I just think it's difficult, right? Because like when you're in this type of situation, a lot of these assets, once they start going parabolic, they can continue going parabolic, and actually this curve can steepen. So the curve can steepen significantly over time, over a short period of time too. So it's like getting in could be a good idea, but it could also be like a terrible idea, because you could either be at the top, or it could do like another 5x, another 10x. So like you see this in meme coins all the time, where it's like really tough to get in, but then you see like people that just ape in with no logic, no background, no strategy, nothing. And they're just aping in when the asset's just, going parabolic and is significantly higher than any previous all-time high. And they still end up making like another 10x or another 20x, and they end up ahead. So it's like really tough to say, like, should you enter? Should you not enter? Because there are situations where when a parabolic asset goes parabolic for a reason, right? That means there's a significantly accelerating demand structure there in place. And that can also be like, I mean, that's how a lot of momentum trades play, is like once you enter on strength. And this chart would be like the ultimate example of strength. The only problem is like, how do you get out? And are you entering at the top? So it's like really tough to trade a lot of these assets, I'd say.
Yeah. And that was a conversation that, definitely I had at the conference in terms of, okay, like we saw the analog to gold, and I'm showing a gold chart here. But silver also has that value as as an asset you need when you're building out, a lot of things that we're seeing in the silicon chips kind of space and other things. So it is an asset that we need in the future for productive reasons, not just gold, which still has that use case, but predominantly it's kind of used for protecting against geopolitical events and other things, which is probably why we saw another leg higher after the events of January 3rd in Venezuela and other things. And now more people being concerned with dollar assets because of, Greenland and other things that have happened over the last week, all of which kind of came out in Davos. But you're exactly right. Like, when we saw gold cross that 4,000 threshold, you saw that like a lot of people, it kind of got up as high as 4,400, and then it gave up those gains because people were like, well, how much higher can it actually go? But then slowly and gradually it came back up, and then had this tail in the last month or so because of those geopolitical events. So, I mean, like, granted, this is kind of an unusual period in history, so maybe that's also contributing to it. But, I think what you're saying is exactly right.
So this is a perfect example, actually, what I was just talking about how would you trade this? So that trend line, like the red line that you're seeing on the chart right there. So that's where I was mentioning, like, there's a wide divergence right now from the price and that red line that you're seeing, like that trend line support. And because it's diverged so significantly, what you want to see now, if you were to turn bearish, is to lose that red line would be one example, right? So, and the problem here is that since it's diverged so significantly, for it to correct, you would have to correct a significant amount for you to even consider it to be a bearish asset anymore. So it's like it can still retrace all the way, like what it's done in the past, right? Like every time, like you saw previously, when it diverged significantly from that red trend line, people were probably getting scared once it started it started dumping all the way back, right? Because it must have dumped like a ton of percentage points there when it retested that trend line. But then now you're seeing it held that trend and then rallied well above it, right? So that's where it's like it can still dump a lot and you could still remain bullish, right? Because like the optimal trade here is, since that red line was never lost, that red support, you could just have held the asset and you would have ended up better than if you were to try and sell it at whatever top you previously thought, which is like one of the hardest parts is getting out properly of these trending assets, because if you exit too early, you miss like generational gains. So like, for example, in Bitcoin, here's a good example. Gold is here as an example, but Bitcoin has the same thing. Like every time it's rallied past a previous all-time high, like for example, like in 2017 or like those previous peaks in Bitcoin, there have been periods where it does like significant multiples after retesting and closing above the previous all-time high. Then it can still go parabolic. So it's like really tough to see like how high these things will actually end up going. In real time, it sounds like, moonshotting these things, but you never really know how high these assets will go once they, reprice so significantly above a previously established area of premium.
Yeah, and that was my argument back in October when I think Michael Berry was kind of posting about AI and quant names in equities, and a lot of people started kind of pulling out their positions. And I was like, this could still be a hockey stick higher, and the applications aren't even here yet. Yet you're gonna trade it on the back of like one person's tweet. I don't think that was the only reason, but like definitely I think that was partly the catalyst. And yeah, I think that this is the tough part for a lot of people to kind of reckon with. And in my opinion, like, I've studied this stuff. I feel like there's a lot of training that goes behind picking the stocks, but there's like almost zero training behind how to actually get out. And that's probably the most important part when you're trading. Like, even as you kind of pointed out, like there was a confluence of us hitting that trend line on January 3rd, like, and you can kind of see it on the gold chart where like it was right on trend. And it happened to coincide with all these kind of macro indicators. And it was a good entry point with a good narrative around it. And that's probably why it ended up taking off. But absolutely no one's like trained at all about like, but where do you take profit then? Like, how do you kind of gauge this stuff? And how do you even train yourself to have the behavior necessary to kind of like, and discipline necessary to take profit when you need to? I think these are all like massive like things that really like we really need to train people in, because I don't think it's happening. But we do have to recognize that, yeah, there's been a lot of things going on more recently. There were the Canada tariffs, like I said, over the weekend, the South Korea tariffs. I mean, some of these things I think probably is also contributed to the sell-off in Bitcoin, or at least kind of the weakness that we've been getting, because this happened on the weekend or happened after markets were closed in equities. And so maybe people were taking advantage of Bitcoin being 24/7 to actually play in that as a macro hedge against it. But also there was this dramatic appreciation in the Japanese yen over the course of the last 24 hours. I'm going to share my screen over here with that as well. I mean, this is a crazy chart to me as someone who used to work in FX, foreign exchange. Obviously, there's a lot of talk right now in the media about, well, is this actually a joint intervention? We still don't know. It's possible that U.S. and Japanese authorities are in fact working together to weaken the dollar and strengthen the yen. But this is like now an 18-month low, and it wasn't like a gradual drop. It was just like, boom, all at once. Again, I think that, whether this is going to actually impact like crypto, I think it will to some extent. But for now, it seems more of a tangential relationship. It doesn't seem like it's direct. I do think this is going to be something that really affects us from a liquidity kind of standpoint. I don't know, Colin, any thoughts around this?
Yeah, I agree. I'm kind of worried about the liquidity prospects. We've run that M2 custom liquidity chart. I think China is pulling it back up for right now. So the liquidity headwinds may take some time to play out. But just like another just note on the fact that these things tend to be momentum driven. Like you can see, even once it loses support there, it just falls off of a cliff. And clearly there was the macro catalyst for that. But it's just, yeah, I mean, this chart is disgusting to look at. I mean, I don't know where we go from here, to be honest.
And that's the
It
thing.
doesn't
Like
look
last
good.
week, we didn't even get a chance to talk about last week because this has been happening in the JGBs, the Japanese government bond market as well, where these are unusual moves. And, like that one, I think was more related to the fact that Sanai Takeichi actually made some comments about, calling a snap election and then saying that like, oh, well, taxes on foods are going to be, withheld for the next couple months, or she didn't. I don't think if she even gave a time frame, but certainly a lot of people priced that in. But these kind of moves, I mean, if you see Japanese government bonds like the 10-year go up to like 3%, normally you're already kind of like, yeah, that's bad. This is kind of a ridiculous kind of move. And we're talking about 4 or 5%. To appreciate like these are some very strange fiscal dynamics that I think are going on like globally. This is a small snapshot of what's happening. Like, I think that theoretically, this should be supporting Bitcoin from that macro kind of narrative perspective. But this kind of goes back to my thesis that I don't think that this is what's driving things at the moment. Like, if it was, I would say like we should be at a very different, much higher place for Bitcoin. Sorry, I was going to cut you off.
So I'm just going to also add that Japan is not a big driver of Bitcoin, I don't think. So when we're building that custom M2 liquidity index, Japan's not a large constituent, by the way. So it wasn't even selected.
No, yeah, I agree with that. I think that, Korea matters a lot more, but it's in the epicenter of all of those Asian flows. So for me, this is why I still pay attention to Japan. Like obviously Japan and China. But I think that even if we don't see those direct flows, they impact everything in its orbit. So I think that what we're seeing right now still worries me. And this is kind of why, like, I was on a podcast with a friend of mine, Chris Perkins, and a bunch of other guys like Austin Campbell and Rom on the Bits and Bips podcast. And, they were saying like they're not going to be buying U.S. assets anytime soon because they're very worried about the price action there. And I push back against it because when I look at the world, I'm like, yeah, I get it. The dollar's weakening. And I've made that argument before. There's like $34 trillion worth of assets that have been purchased by foreign investors, and you're talking pension funds, insurance companies, whatever. And in the past, and I'm talking like the last 15 years or so, like half of that, 70% of that was either unhedged or underhedged. And that's no longer the case. Now there is a real concern from a lot of those same players who are saying, you know what, we want out of the US. Like, or the capital doesn't want to be there anymore because they're worried about where the US could be going. But at the same time, I'll be honest, the fiscal situation in Europe is terrible. I don't want to be investing there either. Like, what is my alternative here? So, for me, I'm still will invest in the US where growth is still picking up, ingenuity is still there. And yes, there are some weird dynamics with the K-shaped economy and other things, but I'm like, for me, ultimately, I still see Bitcoin as macro asset still being a good alternative to most of these things because it's uncorrelated, or theoretically should be uncorrelated to all these other weird fiscal profligacy spending kind of dynamics that are going on in the rest of the world. But I don't know. What do you think, Colin?
Yeah, I think the clear beneficiary here is precious metals, but from like an equity perspective, I think Dahlia also said that he was not fond of U.S. stocks in particular. So he may be echoing those same sentiments, but I agree with your perspective that I originally thought Bitcoin would be a beneficiary of this trade. It would have made sense to me, but for some reason, Bitcoin is not really particularly benefiting. And we've also seen some divergence versus the M2 liquidity index, which previously had such a strong correlation. That correlation has started to break down. The only difference is that the correlation, while it has broken down, the pivot point structure of those two charts, meaning where the chart inflects and around the timing of those inflections, have relatively lined up with Bitcoin still. So I still think it's a really good leading indicator from a macro perspective. But I agree from like a fundamental, like academic lens perspective of what do I think theoretically should benefit from this emerging dynamic globally. I would have expected it to be Bitcoin to be one of those things, but unfortunately it really hasn't. So I continue to play things by the technicals. I don't really believe much in the fundamental stuff. I think fundamentals are just a primary catalyst for the technical move, and being able to identify the technical move is the easier way to enter and exit these markets. But if I was a fundamental investor, I would be pretty pissed, to be honest.
Yeah, I am more of a macro fundamental kind of guy. I mean, I have a quant background by training, but I use quant to kind of get in and get out of positions to just identify those levels. And you're right. I would say like the easier thing to do is be a little bit late to the party, but capture the most of the upside, and that's kind of the cost that you pay in order to, at least have more confidence in what you're doing. Whereas macro is harder. I mean, like you're trying to like really kind of get ahead of these things. Like take an example, like we've got the Fed meeting coming up tomorrow. I don't think anyone's really paying attention to it, by the way. I think that number one, of course, like it's very likely the Fed's not going to do anything here. It's very likely they're going to just take a pause. Like we know that number two, there's going to be a new Fed chair some point in the next few months in May, like whoever that's going to be. And I think right now it's a question of like, okay, it's not going to be Hassett. Is it going to be Warsh? Is it going to be Waller? If it is, like, not just what's going to happen to like, the rate itself, but what's going to happen to like quantitative easing, for example, because Kevin Warsh has strong views against quantitative easing, and that would impact liquidity. I think those things are important, but trying to price it in now, super difficult to the extent where like you really can't do it in a meaningful way. So I think that that's kind of what you're stuck with. Or midterm elections in 2026, like, do you play it now or do you kind of wait? And if you wait, like, are you going to be too late on this kind of stuff? I mean, that's really always the problem. I feel like because being too early is equivalent to being wrong, but being late will also cost you. So oftentimes I think this is why a lot of hedge funds and a lot of other players fall back on technical ways to kind of trade instead.
Yeah, I think that different. So, like from the technical perspective, there's two strategies, or like two big strategies. It's like one is buying the breakout, and the other is like buying support or selling resistance. And that's like the way to be early from a technical perspective is to buy support. The only problem is whenever I tested this, and I've been running these quant models for quite some time and spent around 3 years researching it, there's not a statistically significant number of successful trades that buy support in crypto, in my opinion, just based off of the strategies that I've tested. Maybe someone has a better model, who knows? But in terms of like what I've seen in terms of support being able to actually hold in crypto, it's like a hit or miss several times, where once it loses support, like it'll jump so catastrophically, like you won't even be able to get out. And you see this happen all the time in crypto. It's like, steady move. It's like steady moves for like a short period of time, and then just like a shoot up or down. It's like the volatility compression idea, when there's really compressed and very low volatility in terms of returns, and then you'll see like an explosive move. It happens actually across pretty much every asset class, but that's where it's like really tough, and where the reaction is sometimes, at least in my testing, there's a much higher probability of ending up profitable if you buy breakouts or sell short the breakdown. That has been more profitable in the backtest as well as my own live trading. So in my opinion, I think that's probably the better way to play it from a technical perspective. But I totally agree on the fundamental side. It's like you have to get your predictions right. And it's really tough to do that. And it's also tough to backtest a fundamental like macro perspective, right? Like if it's just based off of like an individual's perspective, like if they have like an off day or have like an off year, like it's really tough to consolidate those into specific rules that you can attribute to that fund manager, for example. So it's like, it's kind of tough to backtest a management style that's purely fundamental rather than based on like a strict rules based or an ML algorithm. But yeah,
I used to have a friend who worked at a macro hedge fund shop, and like, to be fair, they were very disciplined about it. But anytime like a trade would actually end up profitable, the boss would ask them, okay, but did you get it right? Because like it played out the way you thought, your thesis kind of worked out, or did you just get lucky? Like, can you attribute what the actual value add was? So I do kind of love that approach. But we're kind of running out of time. Sorry, go ahead.
Oh, I was just going to say, like my previous job, I spent like half of the time talking to fund managers, using alternative data to make their investment decisions. And it was always hilarious to see like after an earnings call where they would come back and they'd be like, oh, well, the data said this, but the price went the other way. I actually went the other way and I got it right, but it wasn't what I expected, right? Like the price will move in the opposite direction to what they thought that it should, or like they'll get like the trade wrong but still right because the price went in the way they I don't know, they may have put it, but like it's just like a mess, like right, like where the price won't necessarily directly correlate with the outcome of the earnings call in the way that they expect it to. And there were like specific stock names that I won't mention that were egregious in this manner, where it wouldn't trade in the direction of the KPI, like the key performance indicator of the company, and would often trade in the opposite manner. So it's like it's all based on like market expectations, and it's a lot harder to trade in practice than it is like academically based off of what you think should happen.
Yeah, so much of this also comes down to how much is priced in, and if it's very priced in, then actually it might not move the direction you think. Maybe it's good news, could actually perversely be bad news because people are trying to buy the rumor, tell the fact. I mean, there's so much here that comes down to like, it feels sometimes like it's more art than science, and I think this is the tough part when you're trading on the fundamentals. But anyway, as I was kind of saying, I feel like it's going to be a continued busy week for us. I don't think that's going to stop, by the way. Maybe part of that is by design, given the geopolitical kind of situation that we're in. But Colin, it's great kind of like chatting and catching up on today. I think that my view is we're still going to be pinned here, given what I'm seeing on the short gamma side on Bitcoin, but probably for equities, we've got earnings this week. So a lot of tech names are kind of reporting. Probably will keep it well supported. So maybe that's going to, increase that divergence if equities kind of performs well in the way I think it might. But let's see. I think it's going to be an interesting week regardless. So everyone, thanks for listening. Please like and subscribe. Let us know, either on Twitter or Telegram, if you have it, or LinkedIn. Let us know what you want to hear from us. And otherwise, we'll see you next week.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third party investment strategies or digital assets or any website or content related thereto.